In this video, we are going to discuss 10 investing techniques. According to Warren Buffett, you can only tell who's swimming unclothed after the tide has gone out. True investors succeed only when the economy is in a recession, according to the investing guru. When things are going well, it is easy to overlook all safeguards. During this time, almost all investment options perform well, and investors receive favorable returns. However, it is only after a recession that investors appreciate the need of applying the essential concepts, principles of investing. As a result, principles are critical, yet only a small number of people are aware of them. And there has never been a better time than now to learn how to invest. Despite the fact that many sectors of the economy have suffered as a result of the disease and the threat of a world war, some affluent individuals have gained more money than ever before. And how did they do it?
At Entrepreneurs Unity Group today, we will share 10 ideas with you that will help you invest like a wealthy person. So grab a pen and paper and stick around until the end. Before we begin, if you are new here, please like this video and subscribe. Let's get this party started. Shall we? Make a personal financial strategy. The first essential is to completely understand your financial situation. This is especially true if you have never created a financial plan. You must evaluate your current financial condition, identify your risk tolerance, and establish your goals. Whether you're collaborating with a professional or working on your own, this is the first thing you must do. When doing so, one very important aspect that you must always keep in mind is honesty. As corny as it may seem, you must be as truthful as possible. The truth is that it is not certain that you will recoup your investment, but if your roadmap is well crafted, chances are you will.
14. Begin investing early. Investing early has been shown to be profitable, more economical than waiting for a large quantity of money to invest in us. Create art with what you have and build your portfolio gradually. You will gain from the power of compounding if you invest early. Compounding, if you didn't already know, is the process of using money you've earned to make more money. As a consequence, you will earn not only from your initial investment, but also from cumulative capital gains. You have accumulated interest and dividends. A 2-year investment might cost you thousands of dollars. 13. Diversification. Most successful money managers and investors have mastered the art of diversification. Never put all of your eggs in one basket. As the saying goes, while this may seem obvious, you'd be surprised how common sense is when it comes to investing. Diversification is actually rather simple. It suggests that you make a few investments, rather than simply one.
By pooling your funds, you lower your risk. Consider the following scenario. You make an investment in a company, and the company goes bankrupt. Depending on the type of share you possess, you might lose a lot of money. When diversifying, select a varied selection of investments. Different asset categories have never gone up and down at the same time in history. This means that when stocks fall, bonds are likely to increase or decrease, but never at the same rate, the same precise pace. Maintaining a portfolio, on the other hand, guarantees that your losses are minimized. 12. Leverage is required for the building of wealth. Obtain leverage in order to create vast wealth. You are only limited by your resources. Therefore, if you want to acquire a large wealth, you'll need to locate some wiggle room.
Leverage is available in a number of different formats. Financial leverage is the use of other people's money to increase the available cash pool in order to accumulate more wealth. Because there are only 24 hours in a day, time leverage is the use of other people's spare time a day, but it's more like 16 because you're probably sleeping the rest of the time. Because you don't know everything, knowledge leverage is the use of the expertise of others, and someone out there knows more about investing than you do. The utilization of more effective and efficient ways developed by others is referred to as STEMs and technology leverage. 11. Be aware of con artists. Con artists may be found anywhere. Scammers are always looking for their next victim. Don't be one of them. The most of the time, to lure investors, these scam artists use widely circulated news pieces.
They regularly give prospects that appear to be too good to be true. To avoid being taken advantage of, ask as many questions as you can and obtain official documentation. Also, before investing, speak with a lawyer to do a business analysis. 10. Money is king in any event. The outbreak has emphasized the need of saving money. Before making any financial plans, have a cash reserve. The reserve should be sufficient to cover 3 to 6 months of spending. Begin by making a list, prices and amounts, so you know exactly how much money you spend each month. People who had reserves when the virus first hit were most likely untouched by the economic turmoil. Because of their reserves, They were able to sail through the raging waves completely uninjured. We can't control the economy, but we can manage our emergency savings. Make sure you have money set up somewhere safe in case something unexpected happens. 9 Deadly Debts.
When the money is utilized for investing rather than addressing costs, it works effectively. In truth, the vast majority of high net worth individuals accumulate money through debt. B. Individuals who are completely debt-free are in the finest financial shape. And smart investors and business people may face difficulties if their debt levels are not constantly monitored. By taking on debt, you agree to make regular payments in line with the conditions of the agreement, and ensure that all deadlines are reached. Nothing could happen to jeopardize your ability to make the payments on time. We are not entirely averse to you borrowing money. Accept it, but only for investment purposes, not for personal spending. Also, if you must acquire debt, plan to pay it off as soon as possible. It is not always certain that your revenue streams will pay your loan commitments. A notable illustration is the Russia-Ukraine war and the debt-ridden citizens of those regions.
The truth is that emotional decisions almost never work well in the domain of investing, and setting up an automatic investment strategy into your accounts, on the other hand, eliminates emotions from the process, reduces the need to timing markets, and allows you to consistently make money over time. 6. Rebalance. In order to profit, the concept of rebalancing is buy low, sell high. They say it alters the weights of assets in a portfolio to benefit on changes. This technique allows you to sell investments that have appreciated in value while simultaneously acquiring ones that have declined in value. It enables the preservation of the initial asset allocation depending on the portfolio holder's risk tolerance. 5. Conservative bonds are an excellent safe haven investment. When the stock market is doing well, high-quality fixed-income assets are often overlooked by investors, and everyone wants to purchase high-flying technology stocks.
That's okay, nothing is wrong with it. However, in practice, turbulence is common when the market is performing really well. Why? You will make some money. But how long will it be until there is a downturn? Bonds come into play in this situation. Bonds are significant components of portfolios. In turbulent markets, they serve as a cushion by giving investors the option to exit a non-depreciating asset. It is also a mistake to disregard bonds as a key investment strategy, for risk and return are tightly intertwined. Every investor out there is conscientious, finding the best return with the least risk. It is tough to strike the perfect balance, partly because the bigger the predicted gains, the higher the risk of losing money. Risk may emerge in a lot of ways. It might be due to a lack of funds, poor credit or debts. Illiquidity refers to the inability to immediately convert an asset into cash.
Economic conditions are also quite variable and play a significant role in determining the amount of return. So, while investing, keep a lookout for lucrative chances that come with a high level of risk. 3. Boring always wins over exciting. Humans are lured to the latest and finest in the market because they appreciate new experiences. The boundary, however, between an enticing prospect and a practical opportunity is thin, and most people are completely unaware of it. Most investors will confuse an intriguing notion with a genuine investment opportunity. His zeal is usually wrapped up in the latest trend or a new business venture that will revolutionize business, cutting-edge technology, or even an exclusive deal. Most individuals are more concerned with the buzz than with the basics. I hope you now have a better comprehension of the issue after recalling what we spoke previously about integrating emotions and investing decisions.
To avoid being lured like a kid with candy, stick to the boring routine investments. Index funds, blue chip shares, or high-quality bonds are all possibilities. You may miss out on the next big IPO, but you will not miss out on continuous earnings. To keep an eye out for fees and taxes, brokers are paid a fee for each transaction made. On average, fees for each sale or by transaction range between 2 and 5%. Broker commissions vary, so be sure you compare them before making a decision. Furthermore, capital gains taxation may reduce your overall profits. Consider this before investing. The local regulations to establish if taxes are due on your earnings. After you've won, exit the stock market. The stock market is a narcotic. It is commonly associated with gambling. When you start generating excellent money, you will always want more, however.
And finally, when you have made a substantial profit in the stock market, it is prudent to exit in order to avoid catastrophic market downturns and the stress that comes with waiting through weak markets. As you can see, there is always room for fresh investment opportunities. If you like this videos, please like it and comment on it with your idea in order for to choose more content for you in the future. Too eager to see you in the next episodes.